Welcome to our webinar meeting. This is another of SUERF's Buffy Bocconi lectures. We are very pleased that Peter Praet, David Wright, and John Berrigan have joined us today. Michala Marcussen will moderate the meeting.
Thank you very much, Ernest, and thank you to everyone for joining today. I think it's really interesting when it comes to the topic of capital markets union to consider that we have actually quite a long history where there's a recognized need in Europe that we need such an infrastructure of the capital markets union. And just thinking back over the past decade, first we had the great financial crisis, then we had the euro area debt crisis where it became increasingly apparent that a Europe where the cross-border flows focus on debt rather than capital is a source of concern. And back in 2015, we had the 5 Presidents report that set out the idea of strengthening the financial union as one of the key pillars for strengthening Europe moving forward. And indeed, while we've seen a fair amount of progress on the banking union, although that still needs to be completed, the capital markets union is still something that's very much work in progress. Of course, then in 2016, we had another shock with the Brexit referendum, and the discussion then turned to also reorienting the whole way the capital markets union would come about, with the prospect of London no longer being able to offer the same type of financial centre to the project as it would have been able to do had the UK decided to remain inside the European Union. Now, the latest COVID-19 crisis has demonstrated yet a new issue in terms of the capital markets union and perhaps made the project even more urgent. But it also has shown some of the advantages of having a strong banking system as well. And I think this has been one of the key points of the capital markets union is it's not a question of banking or capital markets, it's a question of banking and capital markets. And we've seen how the ECB and the Fed have had to adapt different facilities in the crisis, reflecting the different organization of their financial infrastructures. Now, usually at this point in time, as the chair of the panel, I would introduce all our speakers, but I think our speakers today are very well known to all of you. So I've decided just to call them the Dream Team on Capital Markets Union. So what I'd like to do now is to hand over to Peter Praet to give us some high-level views on the issues related to Capital Markets Union and how he sees the project moving forward. Over to you, Peter.
Thank you, Michala, and hello to everybody. Yes, you could have mentioned, Michala, that we, that means a high-level forum, has finalized a report with 17 recommendations, very granular and precise recommendations to, improve fundamentally the capital market, the functioning of capital markets in Europe in general. So I think one of the main differences that we have with a number of reports which have been published before, by the way, good reports, is here we come with extremely granular proposals. I say 17, but in the 17 you have subcategories there, so we could talk about clusters. This high-level group was formed at the request of the European Commission. Very glad, and Sean, thank you very much. It was extremely, I think, interesting and I hope important for the work program of the Commission in the future. These recommendations are extremely granular, and that means also complicated. I must say personally, I do not understand all the nitty-gritties of these proposals. I think I understand, what we try to achieve. But in our discussion, I think we will have to try to keep the global picture in mind and not necessarily go into all the details of the reports. I mean, they're sometimes extremely technical, but that was the purpose, actually. Now, Michala, you said very rightly that we need it even more than before. So I'd like to go again a little bit in the narrative, which is very prominent in the introduction of the report. I heard recently a number of policymakers at very high level, actually, central bankers and prime ministers even, that the worst is behind us in terms of growth. I would say probably yes in terms of GDP growth, the worst is behind us. But that's not well perceived by vast majority of the population yet. The reason, of course, why you have this discrepancy between, the fundamental problems that we are going to have looking ahead, and the perceptions of people has to do with the fact, of course, that incomes have been largely supported by the public sector, actually by, more public debt. So there has been a lot of income support, a lot of liquidity support from the government side and from central banks, and that also lowered the perception among a big part of the population that actually, there is not really a severe crisis, and we go back to normality. I think that will be a very big issue in looking ahead in the coming months. Also, politically, we had a large degree of harmony, especially in Europe, about the measures to be taken. But the more you go into the next phase 2 of the crisis, the more, of course, political divergence will appear. And I think I say that because it's very important in the Capital Market Union to be sure that we keep, this consensus about reforms in that domain. In other domains, I think it will be quite controversial sometimes. Think about, how much money should you put in healthcare, how much money should you put in climate, and many other things, as you know, how do you deal with cross-border divergences within the unions, etc., etc. So now, so looking ahead, there are two things I want to say. First, there will be a massive reallocation of resources will be needed, not only for legacy businesses. There will be a lot of insolvencies, we know that, bankruptcies, we know that, but also there will be a need for new investment, not only in healthcare, but also in climate, in digitalization, in industries of the future. It is important because when you look, for example, at the performances of stock markets, I'm not talking about the absolute levels, but in terms of relative levels, you see what is happening, the difference between the US and Europe. In US, equity markets are vibrant, not only because of, the role of central bank, of the Fed, in supporting, very easy financial conditions, but also because, the importance of the indices of the future in the equity market in the US, which is not the case in Europe, where you see the differences of performance as basically in terms of weight of technologies in the equity markets. And that is a signal that the allocation of savings that will have to happen in our environment is not very encouraging, and because it has not happened in the past, and we don't see why it would happen in the future. So the reallocation of resources has to happen. It will happen, and has to go, to productivity enhancing sort of investment. And so how can we facilitate this? So that's the first point. Public money will not be sufficient. There is a lot of discussion about the recovery fund and also at the national level about initiatives to, improve, infrastructure or, digitalization and other initiatives, climate also at the national level. But it is clear that there are limits on public money. So private savings has to be mobilized. So that's the first point. The second point, we had it already before. It's the monetary policy environment. Interest rates were expected to remain low for a long time, but Michala, as you also alluded to, interest rates are going to be lower for even longer period of time. So this expectation now that interest rates will not normalize, to some, positive real rate in the near future, this perspective has now disappeared and will probably prevail for a while. And well, we'll see what will happen. But I mean, certainly that will drive, a lot of decisions in capital market. The expectation that interest rates will not normalize, to a positive level for quite a period of time. So that means that the issues that we knew, like search for yield, the question about the viability of insurance, life insurance, the sustainability of life insurance. Many of these questions we had before will now persist and may even be worse than what we have seen before because of that perception that it will be for a very, very long period of time. So that's a search for you. So given the way our capital markets, and that's my next point now, the way our capital markets are organized, the risk of misallocation of savings, I think, given the way our capital markets or financial market is organized, the risk of misallocation of savings, I think, is quite huge. You can think about this, about all the issues I mentioned before. For example, in a number of countries, inefficient bankruptcy procedures. You have the fact that you have a landscape where the banks, which is very bank-centered and country-based very much. You have very risk capital is not very vibrant in our environment. And so the risk of misallocation is important. And misallocation means, for example, that you keep, I would say, zombie enterprise. I'm not a bit fanatic of using that argument, but I think still that is something that is real to some extent. The second is overinvestment in real estate, residential in particular, that we have known in a number of years, but which is likely to continue. And underinvestment in the industries of the future, of course, which is, I think, very scary. Michala, you said, yes, well, these are problems we know since a long time. It's more urgent than ever to change our environment. The question now is that the time you need to have concrete results is now, at best, to be optimistic, very limited. And maybe we are already past, the moment where we're really having more efficient capital market would make a difference, in this crisis compared, let's say, to the US. Fortunately, US has other problems. But so the risk of misallocation of savings in our present environment, I think, is quite high, actually. And Brexit, as you mentioned also, Michala, doesn't help also. Now, the Capital Market Union project was launched by the Commission in 2015 with the Horizon 2019. And we look at the landscape, and this is the starting position of the high-level group, and why the Commission kindly asked us to work on this, was that actually our landscape has not fundamentally changed, actually, as I described before. A lot of improvements have come, we have to admit, and Michala, you mentioned the banking union, but in many areas, it has not, is not fulfilled our expectations. So our high-level group identified this made 17 recommendations. We didn't look into some other very important issues, for example, like the fact that there is no, safe asset in a union. I think it's very important, of course, to have a fully fledged, capital market union, to have a safe curve, yield curve as a benchmark. So I think that would be one. We didn't look into that. There are other studies doing that, and was not really our mandate. The lack of achievement of the banking union, I think it's extremely important. When you look at the banks, for example, today, and you think about the reallocation of savings, Michala, you said the banks are fortunately resilient. Yes, fortunately, that's true in capital and liquidity. But I would add, which you didn't do, they're not profitable. And there will be an assessment coming very soon about vulnerabilities of banks and looking ahead. And I don't know the results of that vulnerability assessment done by the SSM, but I suspect it will not be a very good, outcome from this assessment, basically because of low profitability, lack of strategic perspective, and the fact that, our banking union is still very much a divided, a fragmented union of banking. Now, anyway, banks are not the best, to produce the reallocation of savings I mentioned before. But with the weakness of profitability of banks, I would say it doesn't help. I mean, that's the least we can say. So the second would be the banking union. We did look at that. The third one is the tax bias we have in our societies in favor of debt. And then a number of legal, issues. There are corporate laws related to corporate laws and securities law. And then the issue about financial literacy. We dealt with some of these issues, but of course it's much more profound than the proposals we make in terms of financial education, financial literacy. But it's an important issue. So we look at the investor side, the financing of business. So that was the second working group. And the third was intermediaries. I was co-chair on the intermediaries, and David, who speaks after me, was on the financing of business with a special focus on SMEs. Now, when you look at our recommendation, As I said, they are very granular. And when you look at them, each of them, you would say, well, most of them, that's not a big deal, you know. But you have to consider them as a package. They're mutually reinforcing themselves. And when you deal with a number of frictions and problems we have in capital markets, I think if you consider and implement them all together, we think it's going to make a big difference. So what are these sort of these measures? How can you categorize them? The first set of measures deals with problems of information. I mean, typically, usual problems: access to information, cost of information, but especially in a cross-border setting. David is going to speak, certainly, David, I'm sure, about ESAP, the trying to have in Europe a system of information accessible and free, I would say, as in the US for SMEs, basically, EDGAR, it's a US EDGAR. But there are other issues related to information than that one. For example, we have also recommendations on open finance. To what extent, how far should you go in providing information about the profiles, investment profiles of clients of banks, of retails in general. Then I must say, Sean, that when I looked at preparing this intervention now, looking at all our proposals, it is true that many of them relate to regulation and supervisory issues. For example, you have a lot of strong calls, I think, in our recommendation for a simplification. A number of regulations are too complex. I'm thinking about the PRIPS, for example, here, the KIDS, the key information documentation for PRIPS. But not only there, of course. And so there is a call for simplification. We also think about MAR, about listing of SMEs, so very diverse issues. High compliance cost, I've also seen in my notes. Implementation also costs across countries, implementation problems. If you look, for example, passporting of CSDs, which led to some strategic decisions of some CSD to acquire other smaller CSDs in other countries, but the integration of CSDs and just the simplification of the chain, of post-trade, the change of post-trade, has not brought, the efficiency gains that were expected with the passporting. There is a very important call for revisiting, Sean, capital requirements and liquidity requirements in specific domains. I mentioned here a securitization framework, mark-to-market, market making in general, but also the capital requirements, basically, for banks investing in equities, but above all, insurance companies investing in equities in general. So I think about Solvency II and the treatment of equities in Solvency II. These issues have also been discussed with supervisors, like in this case, EIOPA, being present as observers in the high-level group, and that led to very, I think, fruitful discussion, although they don't they are not necessarily behind the recommendations we made, but we had also the chance, high-level group to discuss directly with, in a very bold way, with representatives at the highest level of supervisory authorities. So the second cluster would go around regulation, the supervisory regime. Then we have also issues which are not supervisory issues, but for example, the tax frictions we have, like the recuperation of withholding tax. On paper, it's not bad because you can recuperate the withholding tax that you paid in another country if you are non-resident, but the administrative burden is extremely high. And that's a friction in the market which has been with unanimity recognized by all participants of the high-level group. Then we have also the issues related to corporate and securities law. We don't deal with all of them, but personally I was surprised to discover, for example, that definition of shareholders was diverging. We don't have a unified definition of shareholders. Personally I didn't even know that. But I think that's one of the frictions you have in the post-trade, for example, treatment of transactions. Then you have also in this domain solvency law, where we make a number of recommendations, not necessarily to harmonize, of course, that will be a very long-term project, but more granular sort of project proposals there. And then we have a financial literacy there. The next point is also, and that was very controversial in our group, it's what sort of reforms do you need at the supervisory level? Do you need to have more direct integrated supervision, as we do, for example, in banking, or do you need to reinforce a little bit the strength of ESMA, but without a fundamental review of the way it is organized today, and how you could at least reinforce the hub and spoke, sort of system we have today. That has been, I must confess, extremely controversial. The chairs and co-chairs have taken a view that you need more integrated direct supervision. But this opinion has not been shared by all the high-level groups. So I think that could also be an interesting point to discussion. Thank you, Michala.
Thank you very much, Peter. And indeed, I think I'd like to pick up on this point of the SMEs, because this is really one of the core issues that we see in Europe today, and especially with the current crisis. If we think about the current crisis, it's particularly tough in terms of its distributional effects, especially because many of the sectors that are hurt have a high share of SMEs and have a high share of employment of low-skilled workers. So we really see those concerns coming through today.
Very right, very right.
In the
very
current
right.
context.
So
excellent. I think what I'd like to do is jump over to David and David, get some of your thoughts on what's happening on the SME sector. And Peter, you were drawing some parallels as well to the US. And we see in the United States that the SBA, the Small Business Administration, is always it almost acts like a type of fiscal tool in some respects in the crisis. And maybe get your thoughts, David, as well on perhaps how we could draw some lessons from the US here.
Yes, thank you very much, Michala, and thank you for inviting me to this distinguished seminar with two of my best friends, Sean Berrigan and Peter Praet, who I have the highest regard for. Let me start by focusing on one of the core themes right through the work of the high-level forum, which was that Europe needs more equity. We need a more balanced a series of capital markets. We need this for different reasons, but especially to spread risk throughout the economy. We need to increase our resilience and possibilities to contain contagion in crisis situations. We saw and we feel that the markets would develop. So it's not an anti-banking position. It's a position to try and grow capital markets, but to grow much more variety of capital instruments. And particularly the work of my group was focused on looking at how we could grow dynamically European SMEs into sustainable growth and indeed to become world-beating companies. And there are obviously two sides to that. There's the public side of that market, the public, the stock exchanges and so forth, and there's private financing and so forth. On the public markets, as is well known, IPOs have been declining for many years, in the US included, after the Sarbanes-Oxley Act in about 2004-05. But the fact is that in Europe, we have failed for generations to grow our SMEs into the world-beating companies. This is not because we lack brains or ideas. We just don't seem to have that ability to take companies to the top level and to be global leaders. We do not have in Europe today one European company, for example, in the top 15 IT companies in the world. And this is serious, because what we see and what we've seen multiple times is that European entrepreneurs grow their businesses to a certain level, and then clear off, usually to the United States, to list and seek the late-stage venture capital and development capital that they need. And so when that happens, Europe loses growth, Europe loses jobs, Europe loses technology, and it doesn't come back. And it doesn't come back. And we've seen this time and time again. I did some work at the end of the 1990s for the President of the Commission. I was in the Cabinet on precisely these problems. We drew up a plan called the Risk Capital Action Plan. And some of the issues that we identified then are exactly the ones that we're identifying now. The fact that the public markets in Europe for SMEs are too small and fragmented and illiquid. The tax discrimination, as Peter mentioned, against equity versus debt is still there. The blockages on withholding tax still there. We have inefficient and now almost absent research on small companies. And we have a cultural issue about risk-taking. Now, it would be wrong to say, and since at the end of the 90s, that there hasn't been some progress. I think there has. I think the European Investment Fund has played a useful role in trying to bridge some of the market failures, EIB as well. There have been some attempts by stock exchanges, various, to deal with this SME problem, but I don't think any of them have been successful, including London. We don't have a NASDAQ in the European Union, and NASDAQ is the source usually where most fast-growing companies tend to list in the United States. But again, I mean, we've had some progress, but we're multiple short of where the United States is. And let me give you an example here. As a result, you mentioned this, Michala, as a result of the US Jobs Act, the last financial crisis, the US set up something that they call business development companies. These companies were non-listed, seeking capital to grow. Well, the size of that market in the United States today is $100 billion or more. And in Europe, frankly, there is nothing remotely similar. And Europe has to learn, I think, from this dynamism of the US capital market, the plurality of financing, and so forth. Now, my own view is that we will not solve these problems in Europe by the public sector alone. I don't deny the use of Invest Europe, the EIF, or the EIB in specific areas where there are market failures. Of course, that can be useful. But in the end, I think there's a danger here that you crowd out private capital from the markets, and it's a private capital that creates the real dynamism in the capital market and creates the multiples and acceleration of business activity. So in the group that I chaired, the subgroup that I chaired in the high-level forum, we looked very carefully at some of these issues and said, what can we do? What are the key things that we can really propose that we think will make a change to the dynamics of growing small companies in Europe? And the first of them, which Peter mentioned, is to set up in Europe what I like to call an EU EDGAR, which is a simple, framed, one-stop free information system managed by ESMA, which will contain all the information on European listed companies in one place. Free for users, harmonized information, standardized accounting information as well, both financial and non-financial information in one place. We think this will make a tremendous difference to the visibility and attractiveness of the European capital market. And when I asked actually recently the head of NASDAQ, the chair of NASDAQ, I asked this distinguished lady, I said, well, what's the one issue that you would implement if you were in charge of Capital Markets Union? And she said that, set up a European EDGAR. Well, that is part of our proposals. The second one is to something that exists but is a failure, which is the European long-term investment funds. Today there are only 20 of these things, but we believe that if they are calibrated properly, a fund structure could be immensely interesting to invest in late-stage venture capital, to invest in green projects, to invest in infrastructure, and so forth. And actually, we think there's an opportunity here to mirror the success of UCITS, OPCVM, and to create a standardized framework for investors, private equity investors, but also retail investors, to invest long-term in those things that I mentioned. I think this is immensely interesting, and it's part of our proposals. The third part of our proposals concerned simplifying the environment for SMEs. The reality is, I think, and I think it's fair to say, and indeed I'm probably partly responsible myself, the current situation in terms of legal situation, in terms of prospectuses, listing, market abuse, create tremendous costs and uncertainties for pending SME listed companies. There's just too much cost, there's too much uncertainty, it's just disproportionate. For example, on market abuse, there's a big issue about when do you disclose to the market, a lot of uncertainty, lack of definition, and it's these sorts of things which are deterrent to small companies. We think it's a good idea to allow small companies to have a transitional process to the listing, to full listing. So over a 5-year period, you take on more and more of the discipline of being a listed company and so forth. The fourth area that we focused on was what Peter referred to, which is to increase the supply of long-term equity capital for SMEs, and that means modifying the capital rules for the Solvency II for insurance, modifying some of the Basel rules, for example, to deal with this issue of speculative listed equity exposures, which is extremely vague. If that number stays at 400%, banks will not invest in SMEs. Securitization, opening up the securitization market. We're not talking about the garbage that came from the United States. We're talking about sensible, prudentially sound securitization with good rules which allow all sorts of different products to be securitized, improve the banking balance sheets, renovates credit from the banks, and allows a new pool of investable asset-backed securities for the supply side. And finally, we believe that developing the pension system in Europe, which is becoming even more inevitable now as public sector deficits increase dramatically in this COVID crisis, that providing the right tools for pension funds to invest long-term through LTIFs in the SME world. Let me make some final remarks, and I believe these cluster of proposals that I've made to you would definitely make a big difference to the dynamics of small company financing in Europe. Let me make some final comments, if I may, about the high-level forum and Peter, which Peter has outlined so well. First of all, we agreed on everything. That's rather interesting because there were 28 of us from many different backgrounds: regulatory, small companies, big companies, stock exchanges, regulators, and so forth. This has been an interesting and consensual exercise. We didn't agree on 2 or 3 points, supervision being one of them, but we agreed on the vast package. And as Peter says, this is an integrated package. It's not a pick and choose package. It's an integrated package. And it's granular. Peter said this a number of times. It goes way beyond all previous reports in being precise with the types of legal changes that are needed, and crucially includes the timetables for delivery. However, I don't believe this is going to work unless there is a major political agreement at the highest level between the European Commission, between the European Council of Heads of State and Government and the European Parliament on the package. Because otherwise, the great risk here is that we drift into years and years of bureaucratic infighting, death by 1,000 bureaucratic cuts, which is what happened in previous exercises. So it is critical, in my view, and the high-level forum supported this position, it is critical that there is a political agreement on the package. Not just on the package, but on the timetable, on the monitoring mechanism to ensure that there is delivery. And if there is not, I'm afraid to say as a European, the major policy issues of the European Commission and the European Union will not be delivered. Our response to COVID will be suboptimal. We will not be able to finance the green transition. Our competitiveness will not improve. Market integration will remain fragmented, and retail investors will not invest in capital markets. Let me stop there, but let me emphasize that it's time for action. It's time to recognize the urgency, and it's time we have a political agreement on how we move forward. Otherwise, I think we risk failure. Thank you.
Thank you very much, David, for that. And indeed, I can only agree with you that we need things to happen quickly here. And I think Peter made the very important point that the banking union is critical as well in securing at least some progress on the banking sector's profitability, which is a point that I can only share. So, John, you're the person who is very well placed to give us some guidance on perhaps a little bit on what we can hope for in terms of the speed of events lying ahead. Is this magic moment in Europe where we will actually get that fast-track acceleration on the capital markets union, and perhaps also on the banking union?
Okay, well, thank you very much, Michala, and thanks to SUERF for the opportunity to speak today, to speak after two eminent persons, Peter and David. We have started our internal reflections based on the report, so we've been waiting for it. Not yet in a position to discuss what we decided yet, but we have started already. And it's a very rich report and plenty of material for us to work with. So let me start by just saying that we're very grateful, very thankful for the work and dedication that the group, the forum, showed in this report. Not least David and Peter, also Marie-Louise and Thomas Wieser. So thank you for that. We brought together in this group a high caliber a high caliber group of representatives of industry, academics, financial services users, consumers, etc. A good cross section to reflect on all areas and all aspects of policy recommendations that would come. I think this has allowed us then to hold a sort of intensive discussions on a wide variety of issues and challenges, and listen to the perspectives, as I said, from very diverse perspectives. There have been many meetings, several rounds of discussion, often in this format, as I'm sure Peter and David can attest to. And now in the end, as both Peter and David have said, we have a report with 17 concrete and granular recommendations, which then fan out into a large number of other sub-recommendations in quite a high degree of granularity. So this gives us a lot of material to work with, but of course also sets the bar high for us in terms of what we deliver. Since the report has been published, we have of course been asking for feedback from stakeholders on the recommendations. That will be open till the 30th of June, which is tomorrow. And then this report, along with the feedback from other stakeholders, will of course then feed into the work, as I said, that we will do. And we have promised and we will deliver the CMU Action Plan Mark II in the fourth quarter of this year. Why do we need Mark II? Why do we need a high-level forum? Well, I think it's clear, and I, of course, as a Commission official, will always argue that we have successfully delivered on the CMU Action Plan. I think we did. We delivered on all the items that we said we would deliver on. The question is whether we delivered in the level of ambition that we set out to deliver on. And there, I think we have perhaps more of a discussion. So even though we have delivered on CMU Action Plan 1, I think it is fair to say that capital market integration still remains insufficient, and certain fundamental aspects of the functioning single market still not there. We clearly have a long way to go. I think there are several reasons why the CMU is not complete, and we have to address those reasons now as we move forward with the CMU Action Plan 2. The first reason, I think, is that a large majority of the actions taken by under the previous action plan by the previous Commission have not yet really come into effect. There was a great acceleration towards the end, which allowed us all to say we'd achieved everything. But of course, the bulk of it was delivered within the last 6 months of the last mandate, and much of this has not yet even had an impact on the market. So we need to keep an eye on the implementation and the effect of Capital Market Action Plan 1 while we're formulating and implementing Action Plan 2. Second, and I think more importantly, the creation of a capital market and structural long-term obstacles, and both Peter and David mentioned some of these. And that always takes time and repeated efforts in the context of the European Union. So bottom line is we need more ambition. And we need more ambition in the sort of areas that have been mentioned, like taxation and insolvency, areas where I have to be honest, political sensitivities run high. And so where you really have to make the case very hard why people who are in charge of taxes, why people who are in charge of insolvency, and perhaps know almost nothing about capital markets, need to do this to make capital markets work. I'm always impressed by my colleagues from justice departments who tell me that I'm in a hurry and that they are used to 1,000 years of jurisprudence and that I should slow down. I just point them to the cost of financial crisis and ask them to speed up. This is the sort of discussion we need to have. And I'll come back to this point that David made about politics and political support at the end. The third reason I think we needed the high-level forum and we needed to relaunch this process is that it's a dynamic initiative and we need constant adjustment. We will probably never finish building capital markets. So this idea of completing the capital markets union always amuses me because we will never complete the capital market. It's always growing, it's always changing, it's always adapting. So whatever we put in place needs to be flexible, adaptable, and indeed the COVID crisis just gives you a very extreme example of the sort of flexibility and adaptability you need to changes in your environment. And then lastly, I think completing the CMU requires significant political will, and this is what David has been talking about, and a lot of courage, in fact, to change what has existed for decades. And now on top of that, you have these two rather new challenges that have come in. These are what we call in the Commission the twin transitions. That's the transition to a sustainable economy, the green agenda, and of course the digital agenda. And these are then added on to a lot of long-standing challenges that have faced the Union. So I think, as I said earlier, when you talk about adapting to change, you're not going to get a more poignant and impactful example of that than COVID. I think COVID crisis has probably changed the way we live and work permanently. It has brought what we hope will not be permanent social and economic damage, but I fear recovery will be relatively slow and certainly a lot slower than we hoped at the beginning. And it must be not just as fast as we can make it, it must also be sustainable. I have to say, without any doubt, we will be clearly in a better position today if we already had the Capital Markets Union in the high-level forums report. So let's be honest, we've missed just another opportunity, and as David knows, because I was with him when he drafted his Risk Capital Action Plan, we have missed quite a lot of opportunities over the years to put in place a capital market. And here we are again. We now enter this new phase of the current crisis, what is now called the re-equitization of the economy. We're reflecting the fact that we entered the crisis overly indebted. We're going to exit this part of the crisis even more indebted. So what we need now is to equitize this wonderful new word, the economy. We need that in the immediate sense, but of course we also need it for the medium term. And I think in its report, the high-level forum attached great importance to market financing to secure further funding of the economic recovery and the economic development of Europe. I think it stresses particularly the need to foster equity investment in reaction to increasing debt levels, as Peter has mentioned. It also flags the economic context will change with COVID. Our economy needs to adjust to that. And I think the case is well made that a more diversified system based both on banking systems and capital markets, is better in guiding economic adjustment, better in allocating resources than just a system very heavily reliant on banking. So all of that message from the high-level report feeds very well into the narrative that is coming out of the Commission in terms of both the recovery to this COVID crisis, but also the medium-term perspective for Europe. I think the report also rightly points out that a fully fledged CMU would be vital for mobilizing long-term investment in new technologies and infrastructure. It'll be needed for tackling climate change, to deliver the new Green Deal, etc. So I would argue that COVID has made Capital Markets Union more necessary than ever. There was that moment, just like in Brexit, there was that moment when people wondered whether or not COVID would derail CMU and make it irrelevant. In fact, quite the contrary. COVID has made CMU even more relevant. That then raises the question that if COVID has done something for CMU in terms of its importance, is there something CMU can do for the COVID crisis in terms of helping to address it? And here I don't want to oversell matters because, let's be honest, CMU is in its essence a medium-term project. I mean, we've been a very long time building it, so it's very medium-term, and we need to accelerate that. But we cannot pretend, of course, that we can do an awful lot in terms of CMU in the very short term needed to address the immediate response to COVID. That being said, I think some of the high-level forum suggestions could add further momentum and facilitate recovery. Among the measures we think could have an effect in the short term are those that aim to simplify listing requirements for SMEs, that promote the use and reach of European long-term investment funds available for investors, measures that support insurers and banks invest, and you will see, at least you'll see soon, that many of these aspects appear in what we are inside calling the MiFID quick fix, which is the corresponding set of measures we want to put in place for the securities market that corresponds to the measures we put in place in the area of bank capital requirements. And these ideas will be coming on the table before the end of the month. So while I cannot claim that these will respond to the CMU recommendations in full, they are certainly inspired by the recommendations from the group. I think it's crucial to understand that, another point I wanted to make here, and it's one that has not been raised by either David or Peter, but I'll make it here, is that we cannot build CMU from the top down or only from the bottom up. I think it requires actions at all levels. I mean, only if you develop local markets, I think, can you make CMU relevant to many of the member states. Particularly after Brexit, that other moment when people ask me, is CMU relevant anymore? At that point, I had to change the narrative and say that, well, CMU pre-Brexit was really about leveraging a very highly developed market that existed in London and seeing to what extent we could extend the benefits of that market more widely across the EU. Post-Brexit, it's a little bit more complicated. The bulk of that market now exists outside of the jurisdiction, and we have to find and work out how we're going to organize ourselves vis-a-vis that. So CMU Mark II is as much about market development as it is about market integration. And that is an important change. And it's clear that we cannot just do a top-down exercise. We have to go into the member states and also build this market bottom-up, but build it bottom-up in a way that it can be integrated and not in a way that just creates another group of obstacles to creating an integrated market in the longer term. So I will conclude by saying that the high-level forum has passed the baton to us. They have set the bar pretty high, I have to say, in terms of what we will have to deliver. We have started our reflection on an action plan. As I said, there will be further consultation. But we will bring this action plan forward in the last quarter of the year, and we hope to have it adopted then in Council conclusions and to get the support of the European Parliament as well. I wanted to finish by saying, of course, I agree with David that you don't make progress without political support. You don't get progress without political courage. But there's no political support possible without technical consensus, because most ministers of finance do not have strong views about the 63 recommendations that the high-level forum put forward. Most of them, and I hope they won't be offended if I say this, don't even know what most of those recommendations mean. However, they are informed in their views by people back home who do know what these mean. And therefore, if you do not get the consensus on the ground, the message up to the political level can be quite dispersed, quite diverse, and lead to exactly what David said, the death by 1,000 bureaucratic cuts. So without technical consensus, no political support. And I think the high-level forum, of course, has been really important in developing that technical consensus. And let's hope that we can use it now to drive home the political support and get the sort of ambition that we in the Commission have been looking for, not just for the last 5 years, but as David and Peter and myself can unfortunately agree to for the last 25 years. Thank you, Michala.
So thank you very much for those comments, and listening to you, especially on the issue of taxation, I'm reminded that I spent a little bit of a time at the Commission as a trainee many decades ago, I should probably say, and I did my final paper on university on optimal capital taxation for Europe. I have a little feeling that if I pulled out the paper today, many of the questions raised would still be quite relevant in the current context. So indeed, we've seen that taxation issue is a particularly thorny one. I also realized...
If I may say that, Michala, I joined DG ECFIN in 1987, and my first file was a withholding tax for Europe. So I can understand you as well, very well.
So we see these challenges, and I realize also, Peter, when I listen to you, I still have a bias of listening to you as a central banker, because I picked up on the fact that you said that there was the positive real rate would remain low for a long time. And I remember this fantastic study the Bank of England put out a little bit of time ago, where they figured out that ever since 1317, we've been on a long-term downward trend of real interest rates, going down an average of 1.59 basis points per annum, which I think is sort of a wonderful forecast. But the fact that you said the word real made me wonder if perhaps you also see some inflation on the horizon. But perhaps that's a topic for a different day. And what I'd like to do, of course, if you want to react, I'd be delighted. But I think, we can pick up on some of the issues that have been coming up here on the chat. And I urge everyone to please do pose your questions. Peter, one of the questions that's coming up here is on that challenge of the low profitability of the European banking system. And the point being raised in the question is that low profitability isn't going to be addressed anytime soon. So how can the banks recover their capital base and strengthen it where necessary once the COVID costs have fully been materializing and coming through here? So perhaps, Peter, if I can kick you off on this question.
No, I don't have a solution, of course, but what really worried me very, very much since some years already is when you look at the price to book. I mean, it's a very simple indicator. And you remember, Sean, you remember, and David, you remember also the asset quality review after the global financial crisis and then the Eurofi crisis. Basically, the idea was, well, the real value of the asset side is bigger than, what the market realizes. And then with disclosure, transparency, in this asset quality review, markets would know. And that, to some extent, there could be securitization because the market value was much lower than the fundamental value. And you would lead to a recovery of the asset values, of the banking sector. And that didn't work. You remember that the price to book, picked up a little bit. And then later on went down, to, around 60% of book value. Now you have the COVID shock, so you get another big fall of the price to book. Now if you take huge banks, Michala, you belong to this small group, you go price to books of 20% to 40% now, 20 to 40%. And in spite also of all these measures that have been taken also, to support banks, I'm thinking about the TLTRO at very good conditions and all that. So this is a real concern. A lot of measures have been taken in Europe in terms of supervision to try to facilitate the shock absorbing capacity of banks, the buffer, that they can continue to lend, including government guarantees. But these measures are very temporary. And so what happens after? I understand from Andrea and Ria that vulnerability assessment has been done. It's not a stress test, but there are scenarios that will be disclosed very soon. And I'm very curious, I must say. So what should be done? I think I think what is extremely important is to give a strategic perspective to the banking sector. The fact that the profitability is low now and for some time is a problem, of course. But if you give a strategic perspective, it changes, of course, very much market expectations and the willingness to put capital in these institutions. So I think completing the banking union, revisiting a number of regulation. I'm not saying that you should sacrifice financial stability. In our working group, we work, Sean, you know that, we work on securitization. I personally don't know because these are very technical things. But at least, it raises a question that maybe there has been some overkill in regulation. It's a question mark for me now, but it's possible because the securitization market, simple securitization didn't work. You know that the ECB has been buying ABSs. I think now it's stopped. There is no volume anymore. ABSs, basically to support the market because it would make really a difference in monetary policy. But in spite of all these measures, it hasn't picked up. Many of us think that it's an important part of the recovery of the banking sector is to download assets, including non-performing assets, at a market price, a fair market price, and securitization instrument would be quite an important instrument to do that. No, it has to be something that works, which is not the case today. I'm not sure, as Sean was saying, many of these things will take time, and the crisis is now. No, this crisis is going to last for a while, so we should try. But that's a good example. The other, of course, is cost and digitalization, which is indirectly, of course, all the efforts you do that at the level in terms of the legal framework, and there are a number of recommendations there also. And then you have to consolidate. So strategic perspective must be based on revisiting regulation, I think, and making it in a balanced way, of course, without sacrificing financial stability, securitization, market math. It's very interesting to see why also the investment banking part in Europe is losing market share in the last years to the benefit of US banks, and trying to identify what are the reasons behind that and so I think there is no easy way, but I think giving strategic perspective is a key, because that acts immediately on expectations, even if it takes more time, to finalize the changes we discussed. No?
I would completely agree with you that the strategic perspective would be a very valuable, and also just getting the visibility and some clarity to perhaps remove some of the uncertainty that we've also seen in recent years. Another big question that's being raised, which I think is a really big one, is this whole story of equitization. It's very easy on paper to say we need to get more capital into our companies, and we realize that it's a far more challenging task when it comes to the reality. Now, we've seen with the crisis that there's been a number of suggestions for various wealth funds and various initiatives to try and fund. And one of the questions that's coming up is, could we imagine a privately funded European recapitalization fund, perhaps with some public support as well, to be a way of channeling individual savings into the capital market? And I wonder, David, if you'd like to pick up on this theme of some kind of fund at the current juncture, and how you would see that as an option. Just thinking about some of the on-the-ground frictions that we may encounter.
Well, I think we'd be in favour, all of us, of of funds, methods, private equity, attracting retail investors into capital markets, into products that would invest in corporate Europe, however small. So I have no bias whatsoever against all sorts of privately funded instruments. One of the proposals, as I said, we put forward, which I think really merits to be seriously looked at, is to make this LTIF structure work, long-term investment funds, which can cover the whole ballpark of the investment field, including small companies, late-stage venture capital, including being open to retail investors. Here's an opportunity for Europe to take, and the green economy. Here's an opportunity for Europe to carve out global leadership with a series of standards like UCITS, as I mentioned. So, I'm in favor of all methods to increase the supply of equity capital across the whole financing chain. I think, as Peter has said, we need absolutely to revisit the insurance and bank capital rules. I'm not talking about tossing them out, but I am talking about making them fit for purpose. Maybe the pendulum after the last crisis probably went too far in a defensive role, and now it has to swing back towards perhaps more rational capital charging. I agree with what Peter said on securitization. I think that's a good example where the rules have been too draconian, have closed off bank financing through securitization and the asset-backed market. One of the criticisms I've heard over many years is that it's precisely in the United States that the big banks can offload their mortgages to Freddie Mac and Fannie Mae, a public institutions par excellence, which failed, of course, in the financial crisis and were bailed out. And Europe doesn't have anything like that. And indeed, one prominent French bank, which will remain nameless, Michala, even proposed to us that we should set up a Freddie Mac, Fannie Mae institution in Europe, possibly under the roof of the EIB. Well, I think that's a little bit premature thinking, but the fact is that a European...
Sorry, Dave, we've lost you for a minute there.
The US banks, big banks have. Plus the fact, of course, the US banks, the majority of them don't apply the Basel standards anyway. So, look, we have to focus on this equity issue for the reasons I and others have given. And I think it's not going to be done in the very short term, but I think determination to do so will change thinking in Europe. I'm absolutely sure of that. One prominent guy said to me, there's a wall of American money just waiting to come in and invest in European fast-growing companies if the conditions are right. And I believe it's not just American money, it's Far Eastern money and so forth. So it's getting the structures right, getting the agreements one after another. Once you do that, once you see Europe's on the move, then we'll find the dynamic. So let's keep open to all solutions.
So, I mean, one of the points that sort of comes up in a number of these different discussions is this implicit question of risk sharing. You just mentioned Freddie Mac and Fannie Mae in the US, David, and I would completely share your view that it's premature to go down that route in Europe today. But just when we look around, we see that this topic of risk sharing comes back again and again. And I think, Peter, you alluded to this in your comments as well, saying that the question of a safe asset has been put aside a little bit in this report. And what's quite noticeable is that many of the 17 recommendations are actually in some ways less about risk sharing and more about improving the overall infrastructure. And I imagine that's something quite deliberate. But John, I wonder if you could give us a few thoughts on how you see this report sitting in that risk sharing risk reduction framework, and whether you think that the way the report has been put forward should give us a better chance of a bit of a quantum leap forward in the current context.
Can I be a bit controversial here and say that I do not wish to bring the risk-sharing, risk-reduction debate into the capital markets union space. It is an utterly sterile discussion, leads us not very far, and I don't think it's necessary. Where I think risk-sharing is very useful in the context of CMU is in the real economic context of risk-sharing, which is risk-sharing across borders, risk-sharing across time, where capital markets tend to be better at that kind of risk-sharing than fractional reserve banking. So I think in the sort of pure economic sense of risk sharing, rather than this one that we have created about legacy risk from 2008 and 9, in that very pure sense, I think capital markets union is very important. But I don't think we want to introduce this rather more, if I say, tailor-made discussion of risk reduction, risk sharing for banking union into capital markets union. Can I just go back on some of the points that were made before? Because I think on this issue of risk sharing between the public sector and the private sector, I think I've come up and I think it's Graham has mentioned it. I mean, if you look at what we have put forward in the recovery plan, the idea is in a sense already there. We have inside that package the idea of re-equitizing the system, partly through all our programs for SME, and then there's this new solvency instrument which is targeted more at bigger corporates. And the idea there, of course, is to use public funds to de-risk private investments and leverage private investments into sectors where we think it makes sense strategically from this sort of value chain sense across the single market. Okay, so not strategic in the sense of defense, etc., but strategic in the sense of the single market where it doesn't make sense to keep one holistic view of the single market and of supply chains, and that's what this solvency instrument is about. And there, of course, this solvency instrument will be injected into companies via SPVs or promotional banks, or indeed through private funds. So the idea is, in fact, to use private investors to leverage them by de-risking certain investments. Now, I worry a little bit about coordination failure here, because when I talk to my colleagues, we are waiting to see what the private sector will pick out as the winners. We're not bad at picking out strategic sectors, but we're terrible at picking out the people who win or survive in those. The market are a bit waiting for us to identify which sectors we think are the ones we want. And so we better, get ourselves organized, I think, quite soon, get this plan adopted, identify those sectors we want to invest in, and then hopefully the private sector will help us to pick out the ones that should get the money that we are putting on the table. And on the banking side, if I had one thing to say on the banking side, it is, I think what we have to do is to take, and Europe has to take, a systemic view of its banking system, and not to view its banking system as a collection of national sectors, which it is doing at the moment. And because it is doing that, it is overbanked, which means we need consolidation. It is under-integrated, which means we need to do much more in terms of making the system efficient. I always make the point that ING over Dutch GDP looks a lot different than ING over European GDP. ING looks much more like JP Morgan over Europe. Over Dutch GDP, it's a very big bank, and a very big bank to handle in terms of managing a failure. So we need to take systemic view. We need securitization, as somebody mentioned. And now, unfortunately, even though we were making great progress on NPLs with a few notable exceptions, countries that started from very high levels, I suspect that NPL progress will be reversed by this crisis. So we will need to think a little bit about how we're going to manage NPLs on all the banks' balance sheet, not just on those balance sheets of banks in the usual countries post-legacy. And there, I think that's a sort of structural measure we have to take. And then in terms of responding to COVID, I think you made the point yourself, we need to get this time consistency right. I mean, we have told the banks to deplete capital and lend. I think the banks would now like to know how quickly they're going to be asked to rebuild that capital afterwards. If we don't give them some clarity on that, I think they may decide they're not going to deplete as much capital as we would want them to do. So it's, I understand the comeback with argument here is the recession will be deeper, the recovery will be slower, and they'll have even more NPLs. But you still have to explain to a bank, I think, how you're going to articulate this time consistency issue between telling them now to lend into risk and how you're going to respond to these lower capital ratios that they will have when they come out the other side of this. And I think we have to be a bit, it's not necessarily my job, but the supervisors need to be perhaps a bit clearer on how the request for rebuilding those depleted buffers is going to come, how urgently people will be asked to rebuild them. There's no kind of magic bullet. European banking went into the crisis in quite weak form structurally. The crisis is not going to help them. It simply makes all the solutions I have listed of consolidation, integration, securitization, just more urgent than they were before.
So thank you very much, John. And indeed, I think your point on the time consistency ties in very nicely to Peter's point also on strategic vision. It's all about giving that visibility. And of course, hope is that one day we will get the fully fledged banking union with the single jurisdiction that will allow us to have this consolidation process. And I'm sort of tempted to throw in a question here on, because there's been a lot of chatter recently about a ECB bad bank idea, and perhaps that's something that one of you may like to pick up on. But just looking over some of the questions that are coming in here, we're seeing a question on US stock index funds that are increasingly more popular than actively managed funds, and what the panel may think about a potential for index-linked investing to help mobilize some of the European retail deposits at a low cost. And there's also a related question, which I know is one of the themes as well in the report, about how to help households access insurance companies and policies from wherever they happen to be. So the idea of promoting mobility during work life and during retirement, so that so the question says, think of retirees having to get a new health insurance when they move at age 67, for example. So some of these questions here for the European households, and I'm tempted to throw in a question that always continues to puzzle me, and perhaps one for Peter, which is this whole question between the cost of equity and the cost of debt. And what we've seen in recent years is that while the cost of debt continues to come down, we've seen that the cost of equity has remained, well, it's harder to observe, but estimates of the cost of equity have remained remarkably stable. We can all speculate as to various explanations around this, but of course there's a lot of complexity. So perhaps just picking up on these various questions, there's clearly a question here on different ideas that can help us make stock investing more attractive, either through the type of products or through the type of access to the mobility of those products that may come with them. And then there's also this challenge on the banks and the profitability. So perhaps if I can ask you, Peter, to pick up first on these broader themes of cost of equity related to cost of debt. And then, David, if I can ask you to pick up on what could make the products more attractive.
Thank you, Michala. It's a fact that equity premium in Europe is quite high, certainly compared to the US, but it's high and very difficult to explain. There are some papers showing that it's related to, it prices some uncertainty, so aversion to uncertainty, not risk, but really uncertainty. But it may reflect all the factors that we described before: lack of information and complexity, regulation. I mean, all what we mentioned before goes in the equity premium. What hinders you compared to other instruments like buying, a bond from a bank, or a deposit with a bank? So there is a question of cost. But to repeat, the equity premium, it's a fact, is very high in Europe. we don't have one explanatory factor. Some factors may be related to a sort of risk aversion or an environment quite uncertainty. So you price a sort of tail risk, you know, in the equity prices. There are papers, NBR paper published recently on this, for example. But I think all the other factors that we explained before, the barriers to entry into equity markets, explain this situation. So there is not one factor. Information, as David was explaining, I mean, information, access to information, cost of information, regulatory requirements on equity investment, financial literacy issues, education, I mean, all these factors come in. So there is not a single factor. I think in the question before about equitization, I personally don't think, you know, that really we should encourage people to invest directly on stock markets. I mean, this is something that can be discussed, but I think retail investors have to invest via the institutional investors, and insurance companies, life insurance, play a key role there. And I think the regulatory requirements, the regulatory regime is probably, well, not equity friendly, to say the least. And I think that's something in Solvency II that has to be looked. I think that's a key aspect. So you have, on one side, the information requirements. There is a supply and listing requirements, complexity issues. But I think the role of institutional investors is key. I'm not so much in favor of saying, you know, people, the general public should, you know, buy directly stocks, you know, and, you know, that discussion, that's, some people say we should encourage that also. But I think we should facilitate the channeling via institutions, insurance, life insurance. I'm very worried about life insurance, companies, life insurance in the future. You know, because that situation of long-term rates, even negative or, you know, very low rates, I think this is untenable already before. Now it's even worse, and it's expected to last for a long time. So there you need to do something urgently in terms of probably recalibration, you know, about requirements. There is too little investment in equity from these institutional investors, I think. Not sure, but I think.
Thank you, Peter. David, I wonder if you would be willing to pick up on this point of index funds and portability as well. And I wonder if I may throw in an extra question here. One of the things that strikes me in the report is that there is this note that's made on the fact that European households have a strong preference for the liquidity of bank deposits. And when I try and think about some of the reasons why that may be, I wonder what role housing plays. Being based here in France, if I wanted for an unforeseen need to take out a second mortgage against the equity value of my home, that would actually be quite difficult for me to do. So for that reason, for example, people can often be holding these higher liquidity needs because it's very difficult to access liquidity through housing wealth, for example. And I wonder if this is something that you've also looked at in your considerations.
Well, thank you, Michala. Just a few thoughts here. First of all, in retail in general, what we have today is a pile of money in zero interest deposit accounts right across the European Union. I don't know the size of this, but it's massive. Money that's just laying there and is not being invested, which is to the long and medium long-term detriment of retail investors as much as it is to the productive side of the economy. So there is a key question, and we try to deal with aspects of this about how do you encourage retail investors to invest more in longer-term investable products. And I think there's a couple of really key issues here. The first one is the trust issue. I mean, the fact is that a large number of a large part of our population simply distrusts the financial sector after the last financial crisis and indeed before. Secondly, there's a massive educational and literacy problem. I suspect all of us learnt maybe a bit of Latin, cooking, and we went to the gym when we were at school, but we certainly didn't learn about finance. And when I put this, Michala, to a good French friend, I said, why doesn't France be the first country in Europe to really develop financing in schools, finance teaching in schools? I was told that the French education unions were Marxist. So, you know, we have a serious set of issues here to somehow educate consumers into the best thing to do. I actually think that independent advice, genuinely independent advice, even genuinely independent robo-advice can greatly help. I think it's under-recognized, but I would have the strictest conditions and very strong qualifying conditions for somebody to call themselves an independent advisor, like our report says, you know, qualifications, tests, and so forth. So what we want to do is to build confidence on the retail side through these various techniques, and this will take time, let's be honest, but also to offer products which are understandable, reasonably priced, and transparent, which has not always been the case afterwards. You could pick up the Financial Times 2 weeks ago and see yet another scandal emerging on pensions mis-selling in the United Kingdom, switching in the United Kingdom. You know, this is the sort of thing that destroys confidence on the retail side. So I very much favor what we said here about understandability, transparency, what Peter said, predictability of charging, and so forth. I think this is absolutely essential. So this is going to take a long time. But obviously, if we face, and consumers and retail face, years and years of zero interest bearing deposits, which looks as if it's going to be the situation, you know, that may also help this process of tempting more retail customers into financial markets. Index funds, cheap, reasonable index-based funds, exchange-traded funds. I mean, in the United States, these are very, very cheap. They're cheap also in Europe, but not as cheap. Why is this? These are the sorts of products, it seems to me, that we want to encourage retail investors. Portability, absolutely, portability of pensions. You know, I perhaps could be criticized a little bit in our report for not paying enough attention to the pan-European pension product, something I've always supported. Pensions is a massive European problem, and I hope that the PEPP is going to work alongside Pillar 1, Pillar 2, and other Pillar 3 pensions. Now, on the housing issue, yeah, I think in some member states, the UK is a good example, ex-member state, you know, all the money of households poured into the property market. Also, you could get very cheap second mortgages. You know, so I think there's a set of cultural issues here as well, Michala. I think it varies very much from country to country. But you don't want everybody pouring money into the housing market and creating bubbles which burst and so forth. And that is, on its own, is a great disincentive to retail in the future to invest in capital markets.
Indeed, we do see a lot of heterogeneity across the individual European member states. And I think, you know, I'm conscious of time here, but I think in rounding off our discussion, one of the issues that has come up in several of these threads is this idea of simplifying regulation. We want strong regulation, but we don't want regulation to be complicated and a burden. And of course, one of the reviews that's also ongoing, and I was thinking about this when the point was mentioned on the lack of research, especially on the smaller companies, is the whole debate about MiFID II. And I wonder, John, if I could ask you to round off the debate today with a few thoughts on the whole regulatory environment, and perhaps if you have a few thoughts to share with us there on the efforts that are ongoing for simplification.
Thank you. Everybody is in favor of proportionality, which is what the simplification discussion boils down to. We should have regulations that are proportional. And what you find in the discussion is that everybody agrees on the principle, but it's on the definition that we have problems. So who and how do you make this proportional? We have tended to look at this and focus on the administrative burden side where you can make progress. I think you can demonstrate that for certain entities, some of the administrative burdens linked to our regulations are excessive. But even there, you find yourself in very interesting discussions about whether or not it is better to report less more frequently or report more less frequently. So even in the area of administrative burden, which you think is rather an objective discussion, you can have very interesting discussions about what does actually proportional mean. Because nobody is willing, as you rightly said, to trade the quality of prudential oversight. So they will have lighter rules, lighter treatment, but they will not trade on the prudential side. So it has to be the same quality. And what you tend to find is that when you offer, let's say, smaller, less complex institutions, lighter, less complex rules, they're not as willing to accept them as you think. So, for example, if you offer a small bank to opt out of, let's say, the complicated capital requirements regulation and just go for 10% leverage ratio, and they want to get out of the complex regulation, but they don't want to take the consequences, which is something simpler, but of course more rigorous. So this is where this proportionality gets in. So we are, and we have looked in our previous commission, we looked at quite a lot around the administrative burden, and there you get a lot of supervisors willing to work as well in lightening. And in fact, what you'll see we come forward with soon on MiFID will be all about alleviating this burden, but always in a way that doesn't fundamentally undermine the quality of prudential supervision, so it has to be proven. But as I said, it's proportionality is a more difficult discussion when you get onto the prudential oversight side and the quality of oversight, because you can have these two different approaches. You can have very complex, risk-sensitive approaches to bank regulation, for example, which involve a lot of reporting and a lot of inputs, which are too heavy for small banks. But in order to compensate for the lighter administrative burden, when you offer them simpler approaches, they're not acceptable either. So as I said, the simple leverage ratio approach, they don't like that too much either. So, proportionality is very much in the eye of the beholder, and we are trying to make this. We are trying to find these ways to get through, but it just isn't so easy. We had this exercise in 2015, one that I launched myself when Lord Hill came in, to go through and try to identify those areas of administrative burden which were excessive. And we have, over the last 5 years, tried to wipe those out. I think there's probably scope in MiFID to do more, and we will do it based on many of the recommendations in HLF. But remember too, I mean, this goes back to the points that have just been made by David. There is a culture problem in Europe. I mean, part of the reasons why people hold deposits is cultural. There's an inertia in the system. This is how Europe has done it. Part of the reason why people, when they inherit money, buy a second house is because it's cultural in Europe. You buy a second house, don't put it in the market. So we have to somehow address this cultural issue. I'm not one of those people who believe that culture is somehow ingrained. You can change culture, you get the incentives right. But interesting enough, and what is often less mentioned, is that there's a cultural problem on the other side of the market as well. SMEs in Europe often don't want to issue equity. They don't want to share ownership with other people. They prefer to have a bank down the road that gives them debt because it leaves them, secure in their own ownership structure. So we often talk a lot about the culture of the retail investor side and how we have to change that. And we really do need to do something with pension funds, which is a broader debate beyond capital markets, where the whole idea of private pension funding has to be addressed in Europe. But we also have to do something on the other side of the market, where SMEs don't want to raise and don't particularly like issuing equity. So we have to also address that fact. But many of them are quite comfortable with the banking arrangement. So it is a huge task we take on here. We need to attract people in. But on the other hand, if we simplify regulation to attract investment into certain parts, we cannot do it in a way that trades off the security of the retail investor. So this is a little bit, and this is where I think Peter is right. We will always probably rely on intermediaries, because we will need intermediaries to take savings from retail and direct savings to SMEs. I'm not sure putting retail and SMEs together is really workable in the first place, but probably even not desirable. So we will need to work on intermediaries, and I should just advertise before I finish that we will next year bring out a retail strategy designed specifically for this purpose, to look at what they're calling the retail journey, to see how it is that we can attract a retail investor into the market, while at the same time making sure that his, of course, he takes a different risk-reward trade-off, that's part of the deal, but he doesn't take a lower level of security than he gets inside a bank. And that I think we have to work on that. And the areas are obvious: disclosures, suitability testing, inducements. We know all the areas that we have to look at. But that will come next year, I hope, middle of next year. Thank you.
So thank you very much, John. And I think this is an excellent point to conclude today, with the perspective of the journey for the retail investor, perhaps for a future panel discussion on these issues. I think we've had the opportunity to cover quite a broad range of topics today, so I'd like to thank all their panelists for their engagement. And I'd like to urge everyone who hasn't done so yet to take time and read the report. I think the point that this report really does stand out for the clarity and the specifics of concrete recommendations, so very well worth a read. And I think at this stage I'll hand back to you, Ernest, for any concluding points you'd like to add.
Thank you very much, Michala. Thank you very much to Peter, David, and Sean for your excellent presentations and the vivid discussion. Thank you also to all our participants who, for their interest, and also for the interesting questions you posed. Thank you very much.
Okay.
Bye-bye.
Thank you.
Thank you. Bye-bye.
Thank you.
Thank you.
Bye.